You're watching the charts, and suddenly the euro violently shoots up against the dollar. No warning. You're left scrambling to figure out what happened. Naturally, you check the financial news, but the headlines are entirely static. There is nothing there to explain the massive move. The reality of the foreign exchange market is that it doesn't run on daily press releases. It runs on the relentless global search for the highest, safest return on investment. If you don't know where the world's major financial institutions are moving their money, you are trading completely blind. You might have heard of the yield curve. Usually it's mentioned on television as a flashing warning sign that predicts an economic recession every few years. But for institutional traders, it is a dynamic, real-time map. It tracks exactly where trillions of dollars are preparing to flow. Once you learn how to read this map, you can anticipate which specific currencies are preparing to surge or drop well before the broader public catches on. This chart plots government bond yields over time. A normal curve slopes upward, compensating longer investments. The short end, 3 months to 2 years, tracks immediate central bank decisions. The long end, 10 to 30 years, reflects long-term economic and inflation forecasts. The overall shape reveals the constant tension between immediate government policy and long-term economic reality. Major central banks, like the Federal Reserve, actively bend this line to meet economic targets. When a central bank uses forward guidance, like a speech promising future rate hikes, the market reacts instantly. This communication alone forces the short end of the curve upward. On the other hand, during large-scale interventions like quantitative easing, central banks buy massive amounts of bonds to physically push the long end of the curve downward. These policy shifts physically redirect the global flow of capital. The core catalyst for currency movement is the interest rate differential. This is simply the gap in bond yields between two competing nations. This chart compares United States and German 10-year yields, revealing a clear gap. With the U.S. Treasury at 4% and the German Bund at 2.5%, the U.S. holds a strict 1.5% advantage. To capture that extra return, a European investor has to actually make an exchange. They are forced to sell their euros and buy U.S. dollars. When international banks, pension funds, and asset managers execute this exact transaction all at once, it creates a massive wave of structural demand for the U.S. dollar. As that interest rate differential widens, it acts as a literal magnet. It pulls capital across the ocean, driving the value of the higher-yielding currency upward. Professional traders don't look at a single yield curve in isolation. They analyze the divergence between two different economies. Consider a scenario where the U.S. curve is steepening. Long-term yields rise faster than short-term ones, signaling robust economic growth and rate hikes. At the same time, the European curve remains flat, showing economic hesitation and transition. When you witness this specific divergence, the resulting macro strategy becomes clear. You formulate a bias to buy the US dollar and sell the euro. You have to approach this system with realistic expectations. Yield curves suffer from time lags. The signals they produce can take anywhere from 6 to 24 months to fully play out. It serves as a macro compass. It tells you what long-term trend is coming, but won't tell you exactly when to enter a trade. To find precise, low-risk entry points, you must layer technical analysis on top of this fundamental framework. Stop reacting to the static news and start anticipating the market. Head to FXNX to utilize our advanced charting tools and 0.0 pip spreads and put these macro strategies